Ratio analysis helps decision makers identify significant relationships and make meaningful comparisons. A single ratio by itself is not very meaningful, so we need to make comparisons within a company by comparing the current year with the prior year, as well as with competitors and industry averages. We can classify ratios into 3 types: liquidity, solvency, and profitability. Liquidity ratios measure the short-term ability of the company to pay its maturing obligations and to meet any unexpected needs for cash. Short-term creditors, such as bankers and suppliers, are interested in these ratios. A widely used ratio for evaluating a company's liquidity and short-term debt-paying ability is the current ratio. The current ratio is calculated by dividing current assets by current liabilities. The magic number is 1, so that a company has enough current assets to cover its current liabilities. Solvency ratios measure the ability of the company to survive over a long period of time. Long-term creditors and stockholders are interested in a company's solvency, particularly in its ability to pay interest as it comes due and to repay the balance of debt at its maturity. The debt-to-asset ratio is a solvency ratio that measures the percentage of total financing provided by creditors. It is computed by dividing total liabilities, both current and long-term, by total assets. The higher the percentage of debt to assets, the greater the risk that the company may not be able to pay its obligations. From a creditor's perspective, a low ratio of debt is desirable. Profitability ratios measure the income or operating success of a company for a given period of time. Both creditors and investors are interested in evaluating profitability. Profitability is frequently used as the ultimate test of management's operating effectiveness. Return on equity is a widely used measure of profitability, but many consider the return on assets to be a better measure of management's ability to use assets effectively because it ignores how the assets were financed. It is computed by dividing net income by average total assets. Return on assets measures the overall profitability of assets in terms of the income earned on each dollar invested in assets. When you compute ratios, remember balance sheet amounts are at a point in time, whereas income statement amounts are for a period of time, such as a month, a quarter, or a year. In comparing an income statement amount to a balance sheet amount, you should express the balance sheet as an average. So take the beginning and ending balances and divide by 2.